MELI just reported earnings. The stock is down 6% in the after hours. It's down about 18% over the last year. It's been really, really bad. I've done many videos on MELI. I've been, you could say, cautiously optimistic about the stock. There's a few risks that kept me away from owning MELI, and those risks have not been getting better. They have actually been getting worse. So I'm going to talk about them in today's video, look at the earnings report, and give you my opinion. So I really hope you enjoy it as always. Now, MELI, you could say, is like the Amazon, early days Amazon, you could say, of Latin America in general. They're growing massively in revenues, about 49% in revenues, about 36% in GMV. Items sold grew 47% year on year. And they also have a financial services kind of platform, which grew 87% year on year. And this is a large cap kind of a stock. And you wouldn't imagine this company growing like a microcap, putting up 46 and 50% revenue growth. And it has been far more sustainable than I myself and many other investors believed it was. Now, if you look at the total buyers on the marketplace, it was about 84.1 million. That's a lot of people. It grew 26% year on year. So that was a reacceleration in terms of the fintech kind of users, which MELI is very popular for this fintech platform, credit cards, debit cards. They have about 83 million people. It grew 29% year on year. And again, very popular for credit cards, consumer loans, personal loans. They also have, you could say, some merchant loans, but most of them are for the consumers. Now, the main reason why I skipped MELI is because of the credit portfolio in general. Now, if you look at the credit portfolio, it might seem like it makes a lot of sense that maybe people want to buy something on MELI, they don't have the money to do it, so MELI gives them credit based on their credit score and based on their income, and they use the credit to buy something from MELI, or they use it to buy something else. A lot of companies do that, and there's nothing wrong with that at all. Now, if you look at the total 90 days plus past due, so this is the number of people that are more than 90 days late on their payment in the credit business, it's about 17.6%. So 17.6% of the people that have loans from MELI are 90 days plus late. This is extremely, extremely high. Now, it has been like that for a while. It's been 16, 17, 18%. Some people told me this is kind of normal, you could say, outside the United States. I'm not an expert, but they told me the underwriting standards are a little bit weaker outside the United States than in the United States. But I'm personally not buying it. Like 17.6% of the people being 90 days plus past due is very, very high. And again, some people said that they kind of do it in a conservative way where it shows 17%, and it's not 17%, but still 17.6% is very, very high. Now, if you look at operating margins, it has been plummeting from 13% to 6.9%. So this is really not good at all. They said a margin compression reflects our decision to invest in key long-term growth opportunities. And again, the company wants to invest for the long term. They're following the Amazon playbook of not focusing on profitability at the moment, and for them to maximize, you could say, their mode, their competitive advantage, logistics, shipping, and everything around it, for them to gain market share, gain customers. And once they pretty much win in Latin America, then they can start to monetize the customers. There's nothing wrong with this strategy at all. And they're kind of doing it in Brazil. In Brazil, they're facing a lot of competition, and now they have a lot of same and or next day shipping, about 199, which grew 39% year on year of items being shipped in one day in Brazil. So they have a lot of competition in Brazil. That's another reason why I decided to stay away, because in the United States we have Amazon and that's it. You know, you have a few others, but it's really Amazon. In Brazil, you have Amazon, you have like Temu, you have Shopee, which is from Sea Limited in Southeast Asia. You have, I believe, Amazon is also in Brazil. Then you have, I think Alibaba has something in Brazil, and there's like 2 or 3 others. So it's not like Amazon and that's it. There's a lot of competition, and those competitors also have resources and they're also investing. So MELI is doing the right thing by sacrificing profitability and investing for the long term to gain market share. There's nothing wrong with that at all. But if you look at what really drove operating margin down, it wasn't really kind of expenses like cost of goods sold. It did drive it down 3%, as the company again is investing for more logistics for them to give free day shipping and next day shipping to win market share from competition. But the biggest contributor to the lower operating margin was bad debt. And this is something that I highlighted in my last two MELI videos. Bad debt contributed a decrease of 3.9% to income from operation in terms of margin. So from 12.9, 3.9% was taken out because of people not repaying the loans because of bad debt. And again, some people said that if they're more than 30 days late, they put it as bad debt and other people pay it. But still, this is crazy. Like, this is a lot. 17% of the people not paying the loan in 90 days. There's no way you could say that this is good news. I mean, the company is good, it's an amazing company. But to me, that's why I kind of stayed away from MELI. So that kind of gives me a suspicion that MELI is doing this, like it has, you could say, lean underwriting standards for them to drive revenue growth in general. Because if they can give credit out to more people, that means they're going to have more sales on the MELI marketplace. And if they have more sales on the MELI marketplace, they can give more credit. And the more credit they give, the more sales they get. And it's like a flywheel effect. But now it's starting to show up in the numbers. And bad debt affected operating margins by 3.9%. So that could be the case. I'm not saying this is the case. I'm assuming. But by the way it looks to me, I mean, that's really a lot. Like, if I was MELI, I think the best way to do it was to like outsource it, kind of like what companies do in the United States, like kind of, you could say, SoFi, and now Robinhood is doing it, where another bank is taking the credit risk, another bank is taking the kind of risk, and the company is originating those loans. That would have been a much better business model, much leaner. But MELI is the one that's extending the loans. And that's something that I personally didn't like at all. So I believe the report was good, the growth was amazing, but the bad debt is really concerning to me, and the amount of competition in Brazil and in Latin America in general. That's why I stuck with Amazon, because Amazon maybe does not have as much upside as MELI. MELI is growing so much faster, but to me, it's just easier to understand. It makes my life easier in general. Now, in terms of the valuation, MELI, it looks extremely attractive. Now, it's trading at 39 times earnings. That, again, might look extremely overvalued. 39 times sound high, but it's not really high, because the company is growing earnings per share like 40%, expect to grow 49% the year after, 30, 34%. They will likely maintain 30 to 35% earnings per share growth for many years to come. So you're buying it pretty much at a one peg ratio, with the earnings growth likely sustainable for the next 3 to 5 years. So I see personally at least a double over the next 5 years with MELI, even a little bit more. I made the calculations about 150% on the upside. So for me, the stock's undervalued. I think it's worth the risk reward here, like it's worth a position. And if I want to open a position, it would be like a small position. But for me personally, I have avoided MELI mainly due to, you could say, the credit stuff and the bad debt. It's been getting worse. It hasn't been getting better. And margins kept on compressing. And yes, they're investing for the long term. But for how long is it going to have to keep doing this? Because Shopee from C Limited, they also have a lot of money and they're also investing. So if they do more things, then they're going to have to do more things, and then it's like a race to the bottom. So that's kind of what has concerned me with MELI. Again, maybe I'm wrong on my assumption, and I believe the stock's undervalued. I think it could play out. But I felt like highlighting some of the risks on the stock, as there's a lot of, you could say, very bullish videos on the company. I decided to do something different for you guys and talk about some of the risks and some of the concerns that kept me away from owning MELI stock. But that was my opinion on MELI. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.